Hi, Wright here with Wright Business Advisors. And I want to talk about one of the most overlooked issues when buying a business, and that is the lease. And more importantly, whether the landlord's willing to work with a new buyer. If the buyer is using an SBA 7A loan, the lender is going to require that the lease term actually aligns with the loan term, which is 10 years. That doesn't mean it has to be a straight 10-year lease, but the buyer does need enough term and renewal options to cover that period. For example, it could be a 5-year lease with a 5-year option, or a shorter base term with multiple options to get you there. This is important. If the landlord isn't willing to cooperate on that, the deal can stop pretty quickly. The other key piece is rent. Lenders and buyers are underwriting the business, based on the cash flow. So if the landlord plans to increase the rent, let's say in a meaningful way, that directly impacts the buyer's ability to service the debt. So there's really no hard rule on a specific percentage, but any material increase in rent needs to be reflected in the financials and ultimately the valuation. In some cases, the deal still works. In others, it can create a gap that has to be addressed. You also want to watch for things like large upfront increases, aggressive annual escalations, unpredictable CAM charges. These can put pressure on the cash flow basically over time. So early in the process, it's important to confirm that the landlord is willing to work with the buyer, provide an adequate lease term, and then keep the structure reasonable and predictable. It may seem like a small detail, but it can absolutely make or break a transaction. So if you have any questions preparing your business for sale or structuring a deal the right way, feel free to reach out. I'm always happy to help.